today inshallah, at the end of this lesson, we will be able to calculate the liquidity ratios, the current ratio and quick ratio. Secondly, we will be able to comment on the ratio results, like how to reach a conclusion. So let's start off with liquidity ratios. Again, there are two ratios, current ratio, quick ratio. Quick recap, these ratios tells you whether the business is able to pay short-term liabilities. The formula is current assets divided by current liabilities. How many times the current assets are of current liabilities? This is what this ratio tells us. Quick ratio is just going to focus on whether we have enough cash or trade receivables. We are going to take inventory out just to see whether our liquid assets are able to pay the current liabilities. So again, the answer will be expressed as ratios, as fractions. To find out, to calculate the current ratio, I need the statement of financial position. So first of all, I need to find what my current assets are. So clearly my inventories are given, accounts receivable is given, cash is given. So these are my current assets of 2013. And these are my current assets of 2012. Basically, these are the things that give me money so that I can pay my current liabilities, my short-term liabilities. So the second thing I want to know is the current liabilities. In 2013, this business had current liabilities of probably $18,000. And in 2012, their current liabilities were $70,000. So these are the payments that you have to make. So in our both ratios, we will be using our current assets and the current liabilities. We will put these numbers in the formulas and get our answers. So let's go ahead and see how we will be calculating. So talking about current ratio for 2012, that's the formula. I'm going to put my current assets here. So I know what my current assets are. For 2013, they are 12 plus 8 plus 1. For 2012, they are 50 plus 16 plus 4. So these are my current assets for 2013. I'm just going to put them in the formula. These are my current assets for 2012. Perfectly fine, divided by current liabilities. The current liabilities were 18 for 2013. And for 2012, the current liabilities are 70. When I asked you what is the liquidity, and you said that liquidity is when we have cash, whenever it's needed. So this is basically cash, 1,000, and this is basically cash, 4,000. But if you say only cash, it will not be complete. What you can say when you have enough current assets so that you can pay current liabilities. So inshallah, in short term, these two amounts will convert into cash. 12,000 is my stock. I might sell my stock maybe in 7 days, 5 days. My customers might pay this amount maybe in 15, 20 days. So I will have more cash. So the complete definition of liquidity will be whether a business has enough current assets to pay the current liabilities. So if we work out, we will get answer as 1.17. I will express it as 1.17 ratio 1. Similarly, for 2012, my answer, if I work out this, my answer will be 1. So I will express it as 1 ratio 1. Now, this means that my current assets are 1.17 times of my current liabilities. So clearly, my current assets are more than my current liabilities. It's good, but for the current ratio, it's not enough. If I look at 2012, my current assets were exactly equal to my current liabilities. This means that I can pay my current liabilities, but this ratio as current ratio is not enough because right now I have only $4,000 cash on me and I have to wait for these two amounts to convert into cash. What if I have to make a payment of $10,000 tomorrow? I might not be able to do that, which means that still I am running a risk. Usually for the current ratio, our ideal ratio is 1.5 to 2. If we have a ratio from 1.5 to 2, we can say that, okay, fine, we are safe. We can make our payments. We have a good liquidity. Now we will calculate quick ratio. So what we do is we take out the inventory from the current assets. We are just interested in looking if our cash and trade receivables can pay for our current liabilities. Because for inventory, we are never sure that how much time it's going to take to convert into cash. In our current assets, we only have two things now, cash and the trade receivables or accounts receivables that are our customers who will pay us. Let's find out the answer. We know that these are our current assets for 2013. And these are our current assets for 2012. Okay, we know the current liabilities. What we just need to do is we will put these figures in the formula. The formula stays, everything stays the same. What we just need to do is we will be minusing the stock from the inventory, from the current assets. Here the stock was 12. I'm minusing the stock or inventory. Here I'm minusing 50, that's my inventory. Now let's see what's the answer. Now this shows that my cash and my trade receivables are not enough to pay the current liabilities. They are 50% of current liabilities or half of current liabilities. Here I cannot pay. It clearly shows that I cannot pay my current liabilities. I'm going to ask you this question. I'm going to ask you, what does that mean? And I expect this answer from you that, sir, we don't have enough cash and we don't have enough accounts receivables to pay for our current liabilities. Similarly, if I see my performance in 2012, it was too poor. My cash and accounts receivables are nearly 30% of my current liabilities, not even half. They're too less. I cannot pay. If I have to make a payment tomorrow, I cannot pay. My liquidity is poor. I can be forced to close down. I might have to sell my assets to pay the money to people. It's a big risk. Though we are improving as we move from 2012 to 2013, but still it's a poor liquidity. We will be moving forward to our analysis now. I'm gonna delete this. These were the results that we got from the previous lesson and from today's lesson. Our gross profit margin is falling. Our net profit margin is falling. Return on capital employed decreased. So profitability overall decreased. Not good. It's bad. Worse. We are worse than the previous years. Okay. Our current ratio is improving. Quick ratio is improving, but still the situation is not satisfactory. Here it showed that current assets, they are enough, but when we found the quick ratio, we found ourselves in danger. So as a first thing, when you are commenting, you have to clearly write whether it's worse or whether it's better. So here the situation is getting worse. Though the liquidity is improving, by liquidity I mean these two ratios there. It's improving, but still it's poor actually. Still we are in risk. Okay. So now we will talk about what are the reasons why gross profit is falling, why net profit is falling, why return on capital is falling, and what are the reasons why these ratios change. So if we don't know the reasons, we cannot take actions. Of course, we need to know the reasons behind the changes in these ratios. Okay, let's first talk about the gross profit margin. Why gross profit margin falls? There are two main reasons. Number one, either we lower down our selling prices. When we lower down our selling prices, this decreases the gross profit margin. Or when our cost of sales are higher, or we can say our goods that we buy, they are expensive. We are paying high price for our goods. These are two main reasons why gross profit margin falls. But to make a conclusion, I need to see what reason holds true in my situation. Both reasons can hold true, or maybe one of them can hold true. I need to apply my answer to my situation. Now, what's my situation? I need to look at my income statement. Okay. If I look for my first reason is either my selling price is lower. If you see the sales revenue is going down, so that's possibly because you reduced your selling price. Whenever you will reduce your selling price, your sales revenue will go down. But still, I will be careful in my comment. I will say possibly I have lowered down my selling price. Or, so this first reason, I can write in my answer. Okay. It's basically due to lowering down selling price. Possibly the business has decreased the selling prices. Now, what about the purchase price of the goods? This will be shown in the cost of sales. Let's look at the cost of sales in the income statement. If I look at the cost of sales, it's the same. It doesn't show that my purchase price is getting higher. It doesn't show that, which means that in my situation, the only reason I can talk about is that my selling price might have decreased possibly. So if I am passing a comment, I have to comment according to my situation. Clearly, I cannot write both of the reasons in my answer. For my situation, this was the reason why gross profit margin fell. So I will say I have possibly the selling prices are going down. That's why the gross profit margin has decreased. And clearly, this is not the reason in our situation. Maybe in some other question, this can be the reason where you will see the cost of sales rising. Now, the question is why gross profit margin increases? It's opposite. It increases because when you charge higher selling price, the gross profit margin will go up, or when you manage to get discounts from your suppliers, the corrective action can be you can go and talk to your supplier, ask him to give you some discounts. If the supplier gives you some discounts, then inshallah this ratio will increase. Or if you can somehow increase the selling price, this will also increase your gross profit margin.